Hello Sector Watchers, welcome to the show. This is the 197th episode of Sector Spotlight for Monday the 13th of November. My name is Julius and I am presenting to you from Amsterdam in the Netherlands. Before we kick off, it's two more shows and then we have episode 200 of Sector Spotlight. For the 100th episode I had my good friend Tommy Dorsey as a guest. I've got 3 weeks, so if you've got any suggestions, ideas on what I should do for episode 200, I'm all ears. Put your comments in the comment section below the video or just drop me an email. Today I want to use the show to go over the sector rotation model. We do that roughly every quarter, and I think it's a good time to see where we are, where we stand, and how the theoretical sector rotation model is now aligned or not aligned with what we are currently seeing in actual sector rotation. Ladies and gentlemen, this is Sector Spotlight. As I said, we're going to talk about the sector rotation model and how it aligns with the current rotations, or maybe not aligns with the current rotations. I assume that the regulars will know where to find the sector rotation model on the site, but for those of you who have never seen it or don't know where to find it, if you go to the perf chart option on the website and you punch in one ticker symbol and then look at predefined groups, S&P sector ETFs, and then this is not what you want to look at. You want to look at this here. So here is the sector rotation model with the kind of rules and ideal rotations and ideal sectors that are outperforming during specific phases of the economic cycle. Now, most people will know the alignment of the various sectors, sector rotation model, so which sector is doing relatively well during which phase of the economic cycle. The crux, or one of the more, an equally important part of the sector rotation model is where we are in regard to a number of macroeconomic variables. And they are listed below this chart. I actually do have a chart list. It's a public chart list that lists those 4 macroeconomic variables, as well as the monthly charts for all the sectors. So if you want to check out that public chart list, copy it to your own system or just look at it every now and then, I'll put the link to that chart list in the description of this video. If we start with the first one, the first variable is consumer expectations. And what we use here is the University of Michigan Consumer Sentiment Index. And each chart, each economic variable has 4 options, as you can see in this matrix. And what I'm going to do is I'm going to look at the chart, figure out if I can find which phase of or basically what the behavior of the chart is, and as a result, which phase theoretically belongs to that chart. And if we look at the consumer expectations chart, it's quite subjective on how to interpret these charts, because look at this one here. It says in a full recession it's reviving, early recovery is rising, full recovery is declining, and early recession it's falling sharply. Now, if you look at this chart and you look at this move here, I could still argue that it is declining or still declining. I could also argue that it is reviving because it's bouncing up after that decline. But I can also argue that it is falling sharply because look at this move here over the last few months. That's a real sharp decline. And I'm not sure whether there is a right or wrong here, but the way I'm going to do it, the way I'm going to take it, because this is a really long-term chart. This goes back to the late 70s. So a move like this, so the move that goes up here started back in 2022. And given the full cycle here, 4, 5 years maybe in a full cycle. Sometimes it's a little longer, sometimes it's a little less, sometimes it's not very clear when the cycle begins or when the cycle ends. But what I'm going to try and do here is, pick up the most recent moves. And my take here is that we are either declining or falling sharply. So we're declining off this high and it's going quite rapidly. It's as I said, it's subjective, but that's my takeaway. Already I prepared obviously for this show and I know what's going to come in terms for the other macroeconomic variables and for the sector rotation. And I think it makes sense to label consumer expectations as declining / falling sharply, which would position it between a full recovery and an early recession. If we go to industrial production, got the IPI, dollar IPI is the symbol on stockcharts.com. And I think this is quite clear. This is flat. If you look over the last, so the peak here was in July 2022. So that's almost a year of no significant moves if you see it in perspective of the last 30, 40 years. So, hang on, 70 years, 1954, so 70 years. I think this is flat, which would mean a full recovery. So we had consumer expectations kind of here, and then we've got industrial production as a full recovery. So that would be here, like flat. So we go to the third one, that is interest rates. I think that it can be classified as rising rapidly. We're still rising. We had a little bit of a consolidation and now we're rising again. So we're rising. I don't think we're peaking yet. That would be the next phase. So when you see UST 5-year US Treasury bonds starting to put another high and start consolidating, then I think it moves to an early recession peaking. But for the time being, we're in full recovery looking at the interest rate chart. So that's right here, rising rapidly, full recovery. And then the last one of these macroeconomic variables is the yield curve. US government 10-year minus 2-year yields. And it is picking up. It's still inverted because we're below zero. So the difference is minus 43 basis points, which means that the 2-year yields are 42 basis points over 10-year yields, making it an inverted yield curve. It used to be over 1%, which is really inverted. That the last time that happened was in the early 80s. So I think it's safe to say we're still flat / inverted. We're picking up, which means that we are in an early recession if you look at the yield curve chart. So wrapping this up means that we've got consumer expectations somewhere full recovery, early recession. We've got industrial production and interest rates both in full recovery, flat and rising. And we've got the yield curve in early recession, flat inverted. So we're shifting to the right-hand side of this graph. And please remember, be aware that as soon as we're floating off this chart, we immediately go to the beginning right here. So what you see is that the macroeconomic variables are working their way down, I should say, the blue curve, which is the economic phase, and the orange curve, which is the market, theoretically the market, which means that we are kind of getting out of a bear market, bottoming out potentially. That is where we are according to these macroeconomic variables. Now let's move on and see how the actual rotations of the various sectors using a relative rotation graph are aligning with what we're seeing in the sector rotation model. So I'm going to go from left to right across the scale here. So not necessarily going around the RRG, but I'm going to start in this case with technology and then work my way, so technology, discretionary, etc. to the right. And then highlight the tails on the RRG. So let's start with technology. If you look at technology, I think that's clearly a positive rotation. We're coming out of weakening, moving back into leading, and we know that that is usually the start of a new up leg in an already existing rising relative trend. So that is a positive. This sector is outperforming. By the way, what I've done for the first time in this episode is I have labeled the market capitalization of these sectors across that table to get a sense of, when we've filled them all, to sense where the majority, where the heavyweight, the concentration of sectors is inside the cycle. So technology is outperforming. I think that's a pretty clear sign. Then we've got discretionary. Discretionary is going the other way. This is clearly an underperforming sector. It's moving, has moved through weakening and has now moved into lagging. So I'm going to label that as an underperformer. If we then go to communication services, that is, just like technology, rotating into the leading quadrant. So that's a positive. That's a sector that is outperforming the S&P 500 at the moment. It's in a strong run. And let's move to industrials. And you can see how that is rotating into the lagging quadrant, has rotated into the lagging quadrant. So that's a clear underperforming. So we've got tech and communication services outperforming and discretionary and industrials underperforming. That is interesting. That's a sort of a conflicting rotational pattern. Let's go to materials. Here's materials, also an underperforming sector, rotating into the lagging quadrant. So materials is also an underperformer. Energy, on the other hand, is going through a setback for sure. That's the long tail moving lower. But it's the highest reading on the RS ratio scale. So it's still an outperforming sector. It's still one of the stronger sectors out there. So we gotta call it energy as being an outperformer. Still. And then the next one is consumer staples. XLP. That is picking up, but it's a very short tail. It's way to the left on the RRG, on the RS ratio scale. So it's not super negative, but it's definitely not a positive either. So I'm gonna make this kind of a neutral to slightly positive, but more neutral than positive, because I think it's if I read this chart here, if you look at the shortness of the tail, there's a very good opportunity, very good chance that this is rolling over. This will, continue a little bit and then roll over and move back down to the lagging quadrant again. If I go to healthcare, it's already doing that. It's rotating inside, improving, but rotating down, rotating lower. So that is kind of going into the underperformance mode. It's moving a little bit to the right, but it's still on the left-hand side, and there's a good chance that it's starting a new down leg in an already declining relative trend. And then we have utilities. It's kind of in the same boat as staples. It's definitely improving, but it's still a very low reading on the RS ratio scale, meaning that it is still in a relative downtrend, but going through an uptick in momentum. Way too early to say that it is an outperforming sector. By the way, these sectors have outperformed a while ago, and they moved to the left-hand side, and they're now picking up a little bit. But just like healthcare, which is already rotating lower, I think that there is a very good chance that utilities and staples will do the same. So this group here of defensive sectors is kind of neutral to negative. Healthcare is negative. These two are neutral to negative. And then if I go to financials, financials is kind of in the middle. It's picking up slightly, but it's kind of neutral. There's no real outperformers or underperforming trend visible. So financials definitely a neutral reading. And then finally we have real estate, and I think that is very clearly a negative. It's rotating, inside improving, rotating back into the lagging quadrant. Something you really don't want to see if you own that, and a clear sign that it is an underperforming sector. Now that we have all 11 sectors, then it's interesting to see that there is no confirmed area. There's not a real concentration of sectors within a specific period, a specific phase of the market. The highest concentration is technology and communication services, and then maybe energy. They're right here, but they're offset by discretionary and industrials and materials, which are still or going into relative downtrends. And then there is kind of okay for financials. It's very negative for real estate, and they're kind of neutral right here. So in a nutshell, they're all over the place. Aside from tech, communication services, those are the strongest concentrations. And that's why I've put the market capitalization, market weight up there, because they are heavyweight sectors. They're offset by obviously discretionary and healthcare, and financials is kind of neutral. So there is not a very clear reading, but I'm going to try and give you my take anyway, because what we've seen is that we had a situation over the last months where there was a clear outperformance for staples healthcare utilities, which was the phase where according to the economic cycle, we were in full recovery and the market started to roll over and go into defense, go into the bear market. I think that if, it's all looking back, but I'm trying to match the current situation with the theoretical model. And for a while, it was very clear. There was defense was leading and the market was in a bear market, and that was a very clear sign. What has happened since is that we've seen a shift to the right. We saw that in the macroeconomic variables. They are shifting to the right. This is going very gradually, folks. This is not happening overnight. This is not happening next week. This is a gradual process. But you do see that these macroeconomic variables are pushing to the right, and they're, which means that we had the full recovery, going early recession, and we're going into a full recession. But from a market perspective, that's a good thing, because it means that we're kind of finding a market bottom and starting a new move up. Because if you look at the alignment of technology and communication services doing really well, that's in the early phases of a new market rally. So a market bottoming out led by technology and communication services. And now we have financials right here. We're going out of real estate. It looks as if we're moving out of staples, utilities, healthcare. So these were green a months ago. They're now, phasing out. Real estate is already very clearly and out. Financials is neutral. And we see tech and communication services already picking up. They're moving higher. They're outperforming the market. So what we really would need for a real alignment is when discretionary sector picks up. So I think that should be the main takeaway for this analysis, for this week's show, but it's, as I said, it's a longer term outlook. As soon as we see the consumer discretionary sector improving again and picking up versus the S&P 500 and vis-a-vis the other sectors on the RRG, as soon as you see the consumer discretionary sector starting to pick up and move, let's say, into that northeastern direction at a heading between 0 and 90 degrees, getting in line with technology and communication services, I think that sort of move in combination with the macroeconomic variables shifting to the right would give us a very good indication that the market is bottoming. Economy is in full recession and in a while starting to move to its first early recovery signs. That will come from the macroeconomic variables. But I think that, looking at all the information, looking at the shift of the cycles here, looking at the concentration of outperforming sectors at on the labels across the top, I think that we are positioned pretty much on the edge of the graph, like here and here, and getting out of staples, healthcare, utilities, real estate for sure, to a degree financials, into tech, communication services. Energy is a little bit of an odd one out. So as soon as we see discretionary picking up, and maybe then industrials, that's the sign that we're kind of getting out of that, completing that market bottom and starting the first phase of a new bull market. I hope that makes sense. I hope that I've been able to kind of give you the high-level overview of where I think we are, reading the macroeconomic cycle charts and aligning the rotations on the RRG with what's currently happening in the sector rotation model. There's one more thing that we can do here to kind of confirm or deny all this analysis, and take a look at the monthly RRG, because this is a very long-term type of analysis, so a monthly RRG makes sense. And if we do that, we can see how tech is doing really well, that aligns. How communication services is doing really well, that aligns. And here we see consumer discretionary actually picking up, which would be interesting because you see how that aligns with tech and communication services. You see the energy sector long-term moving out, which would justify energy being right on top here. We see industrials being very close to the benchmark. It's moving out of favor. That does not align. That's the same as the weeklies. We've got real estate totally aligning, moving out of it. You see utilities getting out of it. That's interesting. You see financials getting out of it. That's interesting. You see healthcare moving out of it. That's aligning. And you see staples moving out of it. That's aligning. And you see materials moving out of it. So here it's longer term moves, but probably gives us a better picture that we are concentrating, because here the discretionary sector was actually in line with tech and communication services. So this kind of reinforces, confirms my view that we're moving to the right. We're moving off the edge of the sector rotation model chart and going back to the beginning with tech, com services and discretionary concentrating the outperformance, and basically all the others in underperformance. So the concentration is here at the start of this cycle with 29, 38, 48, 49% of the market concentrated here, 49% of market capitalization concentrated at the start, at the market bottom. I think that means something, especially when you put it together with the sort of line in the economic cycle that is moving to the right of the chart and going back to the beginning. And then a quick look at the moves in the S&P 500 just to wrap up the show. And what I want to do is I want to use our new Sharp Charts workbench. And if you haven't tried it out, it's right here. It's one of the technology previews. If you click on this one, you will get the new Sharp Charts workbench. And I really love it, because one of the features that I really like is that the chart is centered on your screen. You can actually toggle that, whether you want it to the left or the right. There's a setting for that. But also you can play around here. You can make that chart smaller or bigger, or make better use of your screen real estate. Obviously all your chart lists and the saved charts are still there. You can browse through them, toggle through them, and then the layout of the settings here at the bottom has changed. If you have some time, play around with it, and please let us know what you think of that new improvement. It's getting closer and closer to its actual release, still now in beta. Anyway, here's my S&P 500 chart. It's the weekly chart. We discussed it last week. Not a lot changed. We're still fighting with that old neckline. So that head and shoulders being computed has been executed. We actually had the pullback, and we tested the target area of that head and shoulders top. We reached it, but that's it. We marginally reached it, so it has been fulfilled. But then we rallied sharply, and we're now back in the area of that neckline. And you can see that even better when you go to the weekly chart of the S&P 500, and that's this one here. And let's take a look at that, because you can see how we're now actually today, this is Monday, the market is open right now, we are continuing to push above that neckline and above that gap resistance area. So we're building up more and more strength. So it's going to be interesting to see how it's going to continue the remainder of the week. But I do feel that the first signs of more improvement are given. And if you align that with what we just saw in the sector rotation model, that we're kind of shifting and we're coming out of that market bottom, and technology, communication services are picking up. Discretionary is doing really well on the monthly, but not so good on the weekly. So when you see that tail on the consumer discretionary sector picking up on the weekly RRG, I think that could be a very interesting clue for the rest of the year, probably, maybe the start of the new year. And this wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight is available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video, and if you want to reach out, use any of the handles on the screen. I'm looking forward to seeing you again at a new episode of Sector Spotlight. Same time, same place.